So when we talk about a discussion of internal control in cash, we can't help but to have a discussion around fraud, its types, and the common characteristics. So we'll discuss internal controls, which are the primary means by which fraud as well as unintentional financial statement errors are prevented, and we'll discuss how to account for cash. And cash becomes particularly susceptible to fraud because it is so liquid. And cash is probably the asset that is most often misappropriated through fraud. So we want to describe fraud and its impact. Fraud is an intentional misrepresentation of facts made for the purpose of persuading another party to act in a way that causes injury or damage to that party. Fraud is a huge problem and is getting bigger, not only in the United States but across the globe. Recent surveys of large and medium-sized companies in the United States and Canada revealed that over 75% of businesses surveyed had experienced fraud. Over 50% of companies had experienced 6 or more instances of fraud in only 1 year. In 2007, companies lost on average of $2.4 million each to fraud. That's up from $1.7 million each in 2005. 1 out of every 5 American workers indicated personal awareness of fraud in the workplace. So fraud has literally exploded with the expansion of e-commerce via the internet. In addition, studies have shown that the percentage of losses related to fraud from transactions originating in third world or developing countries via the internet is even higher than in economically developed countries. There are many types of fraud. Some of the most common types are insurance fraud, check forgery, Medicare fraud, credit card fraud, and identity theft. The 2 most common types of fraud that impact financial statements are misappropriation of assets and fraudulent financial reporting. Misappropriation of assets is committed by employees of an entity who steal money from the company and cover it up through erroneous entries in the books. Other examples include employee theft of inventory, bribery or kickback schemes in the purchasing functions, or employee overstatement of expense reimbursement requests. Fraudulent financial reporting is committed by company managers who make false and misleading entries in the books, making financial results of the company appear to be better than they actually are. The purpose of this type of fraud is to deceive investors and creditors into investing or loaning money to the company that they might not otherwise have invested or loaned. Both of these types of fraud involve making false or misleading entries in the books of the company. We call this cooking the books. Of these 2 types of fraud, asset misappropriation is the most common, but fraudulent financial reporting is by far the most expensive. This graph forms the elements that make up virtually every fraud. We call it the fraud triangle. The first element in the fraud triangle is motive. This usually results from either critical need or greed on the part of the person who commits the fraud or the perpetrator. Sometimes it's a matter of just never having enough because some persons who commit fraud are already rich by most people's standards. Other times the perpetrator of the fraud have legitimate financial needs, such as a medical emergency, but he or she uses illegitimate means to meet that need. The second element in the fraud triangle is opportunity. The opportunity to commit fraud usually arises through weak internal controls. It might be a breakdown in a key element of control, such as improper segregation of duties and or improper access to assets, or it might result from a weak control environment, such as a domineering CEO, a weak or conflicted board of directors, or lack of ethical practices, allowing top management to override whatever controls the company has placed in operation for other transactions. The third element in the triangle is rationalization. The perpetrator engaged in distorted thinking such as, I deserve this, nobody treats me fairly, no one will ever know. And so we tend to just start rationalizing away the fact that we did it and that it didn't hurt anybody, and so it's all right, which we know is not. So now we want to explain the objective of setting up an internal control system. The primary way that fraud, as well as unintentional errors, is prevented, detected, or corrected in an organization is through a proper system of internal control. Internal control is a plan of organization. It's a system of procedures implemented by company management and the board of directors. Internal control is designed to accomplish 5 objectives. Safeguarding assets. So a company must safeguard its assets against waste, inefficiency, and fraud. If they don't, these assets will slip away. The objective of internal control is to encourage employees to follow intercompany procedure, or to follow company procedure. Everyone in an organization, managers and employees, need to work toward the same goals. A proper system of controls provides clear policies that result in fair treatment of both customers and employees. A third objective is to promote operational efficiencies. Companies cannot afford to waste resources. They work hard to make a sale, and they don't want to waste any of the benefits. The fourth objective is to ensure accurate, reliable accounting records. Accurate records are essential. Without proper controls, records may be unreliable, making it impossible to tell which part of the company is profitable and which part needs improvement. A business could be losing money on every product it sells unless it keeps accurate records for the cost of its products. And then finally, we want to, our internal control system should help us comply with legal regulations. Companies, like people, are subject to laws, such as those of regulatory bodies like the SEC, the IRS, and state, local, and international governing bodies. Companies, like people, disobey the law, and then they become subject to fines, or in extreme cases, their top executives may even go to prison. Effective internal controls help ensure compliance with the law and avoid legal difficulties. And so then we talk, well, how critical are internal controls? And they are so important that U.S. Congress has passed a law to require public companies, that is, those who sell their stock to the public, to maintain a set of internal controls and to require that their auditors examine these controls and issue audit reports as to their reliability. To address public concerns, Congress passed the Sarbanes-Oxley Act of 2002, SOX. SOX revamped corporate governance in the United States and profoundly affected the way that accounting and auditing is done in public accounting. Here are some of the SOX provisions. Public companies must issue an internal control report, and the outside auditor must evaluate and report on the soundness of the company's internal control. The Public Company Accounting Oversight Board oversees the audits of public companies. An accounting firm may not both audit a public client and also provide certain consulting services for that same company, and there are stiff penalties that await violators. This diagram depicts the shield that internal controls provide for an organization. Protected by this shield, which provides protection from fraud, waste, and inefficiencies, companies can do business in a trustworthy manner that ensures public confidence, an extremely important element in maintaining the stability of financial markets around the world. So, internal control can be broken down into these 5 components: control environment, risk assessment, information system, control procedures, and then monitoring. The control environment, symbolized by the roof over the house in the previous slide, is the tone at the top of the business. It starts with the owner and the top managers. They must behave honorably to set a good example for company employees. They must demonstrate the importance of internal controls if they expect employees to take the controls seriously. A key ingredient of the control environment of many companies is a corporate code of ethics, modeled by top management, which also includes provisions as prohibition against giving or taking bribes or kickbacks from customers or suppliers, a prohibition of transactions that involve conflicts of interest, and provisions that encourage good citizenship and corporate social responsibility. When a company executive or manager fails to abide by and enforce internal controls, it sends a message to the employee that the control procedures are not really important. Symbolized by the smoke rising from the chimney, assessment of risk that a company faces offers hints of where mistakes or fraud might arise. A company must be able to identify its business risk as well as to establish procedures for dealing with those risks to minimize their impacts on the company. For example, Kraft Foods faces the risk that its food products may harm people. American Airlines faces the risk that planes may crash. And all companies face the risk of bankruptcy. The management of companies, supported by their boards, have to identify these risks and do what they can to prevent those risks from causing financial or other harm to the company, its employees, its owners, and its creditors. Symbolized by the door of the building, the information system is the means by which accounting information enters and exits. The owner of a business needs accurate information to keep track of assets and measure profits and losses. Every system within the business that processes accounting data should have the ability to capture transactions as they occur, record or journalize those transactions in an accurate and timely manner, summarize and post those transactions in the general ledger, and report those transactions in the form of account balances or footnotes in the financial statements. Also symbolized by the door, control procedures built into the control environment and information system are the means by which companies gain access to the 5 objectives of internal controls discussed previously. Examples include proper segregation of duties, comparisons and other checks, adequate records, proper approvals, and physical safeguards to protect assets from theft. Symbolized by the windows of the building, monitoring provides eyes and ears so that no one person or group of persons can process a transaction completely through without being seen and checked by another person or group. With modern computerized systems, much of the monitoring of day-to-day activity is done through programs or control programs entered into a computer's information technology. Control computer programs dealing with such systems as cash receipts and cash disbursements can be automatically programmed to generate exception reports for transactions that exceed certain predefined guidelines for special management scrutiny. In addition, companies hire auditors to monitor their controls. Internal auditors monitor company controls from inside to safeguard the company's assets, and external auditors test the controls from the outside to ensure that the accounting records are accurate and reliable. In a business with internal controls, no important duty is overlooked. Each person in the information chain is important. The chain should start with hiring. Background checks should be conducted on job applicants. Proper training and supervision, as well as paying competitive salaries, helps ensure that employees are sufficiently competent for their jobs. Employees' responsibilities should be clearly laid out in position descriptions. In processing transactions, smart management separates three key duties: asset handling, record keeping, and transaction approval. For example, to avoid lapping of receivables, the duty of cash handling from record keeping for customer accounts receivable should be separated. Ideally, someone else should also review customer accounts for collectability and be in charge of writing them off if they become completely uncollectible. No person or department should be able to completely process a transaction from beginning to end without being cross-checked by another person or department. For example, some division of the Treasurer's Department should be responsible for depositing daily cash receipts in the bank. The Controller's Department should be responsible for recording customer collections to individual customer accounts receivable. A third employee, perhaps someone in the Controller's Department who reconciles the bank statement, should compare the Treasurer's Department daily records of cash deposited with totals of collections posted to individual customer accounts by the Accounting Department. To validate the accounting records and monitor compliance with company policies, most companies have an audit. An audit is an examination of the company's financial statements and its accounting system, including its controls. Audits can be internal or external. Internal auditors are employees of the business. They ensure that employees are following company policies and operations are running efficiently. Internal auditors also determine whether the company is following legal requirements. External auditors are completely independent of the business. They are hired to determine whether or not the company's financial statements agree with generally accepted accounting principles. Auditors examine the client's financial statements and the underlying transactions in order to form a professional opinion on the accuracy and reliability of the company's financial statements. Accounting records provide the details of business transactions. The general rule is that all major groups of transactions should be supported by either hard copy documents or electronic records. Examples of documents include sales invoices, shipping records, customer remittance advices, purchase orders, vendor invoices, receiving reports, and counts of checks. Documents should be pre-numbered to assure completeness of processing and proper transaction cutoff, and to prevent theft and inefficiency. A gap in the numbered document sequence draws attention to the possibility that a transaction might have been omitted from processing. To complement segregation of duties, company policy should limit access to assets only to those persons or departments that have custodial responsibilities. For example, access to cash should be limited to persons in the Treasury Department. Cash receipts might be processed through a lockbox system. Access to inventory should be limited to persons in the company warehouse where inventories are stored, or to persons in the shipping and receiving functions. All manual records of the business should be protected by lock and key, and electronic records should be protected by passwords. No transaction should be processed without management's general or specific approval. The bigger the transaction, the more specific approval it should have. For individual small transactions, management might delegate approval to a specific department. What's an easy way to remember the basic control procedures for any class of transactions? Look at the first letter of each of the headings in this section. Smart hiring practices and segregation of duties, comparisons and compliance monitoring, adequate records, limited access to both assets and records, and then proper approval, either general or specific, for each class of transactions, which gets us to the mnemonic SCALP. Accounting systems are relying less on manual procedures and more on information technology than ever before for record keeping, asset handling, approval, and monitoring, as well as physically safeguarding the asset. When a company employs sophisticated IT, the basic attributes of internal control, SCALP, do not change, but the procedures by which these attributes are implemented change substantially. For example, segregation of duties is often accomplished by separating mainframe computer departments from other departments and restricting access to the IT department only to authorized personnel. Within the computer department, programmers should be separated from computer operators and data librarians. Access to sensitive data files is protected by password and data encryption. Electronic records must be saved routinely or they might be written over and erased. Comparisons of data that might otherwise be done by hand or performed by the computers. Computers can monitor inventory levels by item, generating a purchase order for each inventory when it reaches a certain level. The use of computers has the advantages of speed and accuracy. However, a computer that is not programmed correctly can corrupt all the data, making it unusable. It is therefore important to have experienced and competent people to run the IT department, to restrict access to sensitive data and the IT department only to authorized personnel, to check data entered into and retrieved from the computer for accuracy and completeness, and to test and retest programs on a regular basis to assure data integrity and accuracy. In addition, it is important that users of the technology are properly trained and monitored because the quality of the output is only as good as the quality of the input. Businesses keep important documents in fireproof vaults. Burglar alarms safeguard buildings, and security cameras safeguard other property. Loss prevention specialists train employees to spot suspicious activities. Employees who handle cash are in a tempting position. Many businesses purchase fidelity bonds on cashiers. The bond is an insurance policy that reimburses the company for any losses due to employee theft. Before issuing a fidelity bond, the insurance company investigates an employee background. Mandatory vacations and job rotation improve internal control. Companies move employees from job to job. This improves morale by giving employees a broad view of the business. Also, knowing someone else will not do your job next month keeps you honest. E-commerce creates its own set of risks. Hackers may gain access to confidential information such as account numbers and passwords. E-commerce pitfalls include stolen credit card numbers, computer viruses and Trojan horses, and phishing expeditions. To address the risk posed by e-commerce, companies have devised a number of security measures, including encryption. The server holding confidential information may not be secure, so one technique for protecting customer data is encryption. Encryption rearranges messages by a mathematical process. The encryption message can't be read by those who don't know the code. Also, firewalls limit access into a local network. Members can access the network, but non-members can't. Usually several firewalls are built into the system. Think of a fortress with multiple walls protecting the king's chamber in the center. At the point of entry, passwords, personal identification numbers, and signatures are used. More sophisticated firewalls are used deeper in the network. Unfortunately, most internal controls can be overcome. Collusion, two or more people working together, can beat internal controls. Ways to circumvent a good system of internal controls include management override, human limitations such as fatigue and negligence, and gradual deterioration over time due to neglect. Because of the cost-benefit principle discussed in the next paragraph, internal controls are not generally designed to detect these types of breakdowns. The best a company can do in this regard is to exercise care in hiring honest persons who have no conflicts of interest with existing employees, and to exercise constant diligence in monitoring the system to ensure it continues to work properly. The stricter the internal control, the more it costs. An overly complex system of internal control can strangle the business with red tape. How tight should controls be? Well, internal controls should be judged in light of their cost and benefits. So now we want to talk a little bit about the design and use of a bank reconciliation. Cash is the most liquid asset, and because cash is the most liquid asset and medium of exchange, it's easy to conceal and relatively easy to steal. As a result, most businesses create specific controls for cash. Keeping cash in a bank account helps control cash because banks have established practices for safeguarding customers' money. The documents used to control the bank account include the signature card, the bank statement, the deposit ticket, the bank reconciliation, and checks. Signature cards are executed by the banks, and they require each person authorized to sign an account to provide a signature card. This protects against forgery. Banks will not cash checks that don't bear an authorized signature, and for checks presented at the bank in person, will often check the signature against the one on file. Banks supply standard forms such as deposit tickets. The customer fills in the amount of each deposit and lists the detailed amounts of each check being deposited and the amount of cash included in the deposit. As proof of the transaction, the customer gets and keeps a detailed deposit receipt. To pay cash, the depositor can write a check, which tells the bank to pay the designated party a specified amount. There are three parties to a check: the maker, who signs the check, the payee, to whom the check is paid, and the bank on which the check is drawn. Checks written by companies often have a stub attached, called a remittance advice, that tells the payee the purpose of the payment. The payee is required to endorse the back of the check when cashing it as proof that only the authorized employee received the funds. Banks send monthly statements to customers. A bank statement reports what the bank did with the customer's cash. The statement shows the account's beginning and ending balances, cash receipts, and payments. Included in the statements are copies of the maker's canceled checks or the actual checks. Often this is done electronically now, where the bank doesn't return the check, but a copy of the front and back of it as it cleared is available online. Electronic funds transfer, or EFT, moves cash by electronic communication. It is cheaper to pay without having to mail a check, so many people prefer their mortgage, rent, utilities, and insurance be paid by EFT. Companies also pay bills using EFT because it enables them to control their cash more closely by knowing exactly when the money will leave the bank account. There are two records of a business's cash: the cash account in the company's general ledger, and in the bank statement, which shows the cash receipts and payments transacted through the bank. The bank statement is generally more independent. The bank is considered a third party. And so the books and the bank statement usually show different balances. Differences arise because of a time lag in recording transactions. So here are some items that appear in a bank reconciliation. They are all caused by differences between the bank balance and the book balance. Items to show on the bank side of the bank reconciliation include deposits in transit or outstanding deposits. You've recorded these deposits in the general ledger, but the bank has not cleared the deposit yet through your bank, so that creates a difference. Outstanding checks. You've recorded these checks in the general ledger, but the bank has not yet paid them because they haven't been presented for payment by the payee. Again, this creates a difference between the cash balance on the general ledger and the bank balance on the bank statement. And then there are bank errors. And so maybe a bank transposes the amount it cleared a check for, or just cleared a check for a different amount. That causes a reconciling item between the GL and the bank statement until the bank corrects that and reflects it correctly on the next statement. Items to show on the book side of the bank reconciliation are bank collections. So bank collections are cash receipts that the bank has recorded for your account, but you haven't recorded the cash receipt yet. Electronic funds transfer. The bank may receive or pay cash on your behalf via an EFT that you may not have recorded on the general ledger side yet. Service charges. These are not uncommon. The bank debits your account or removes cash from your account for service charges. You don't have the exact amount of those, so you can't record those on your books until after you've gotten the bank statement. Interest revenue on your checking account. So if the bank pays you interest and deposits that into your account, you may not know the amount of that interest in order to book the adjustment to your general ledger cash account until you receive the bank statement. And then the same is true if there could be errors that are made on posting in the general ledger that aren't caught until we do this bank reconciliation, and we have to correct those book errors. And so this is just a summary of reconciling items and on which side they appear and if they are added or subtracted. The bank reconciliation is an accountant's tool separate from the journals and ledgers. It does not account for transactions in the journal. To get the transactions into the accounts, we must make journal entries and post to the ledger. All items on the book side of the bank reconciliation require journal entries. Some entries that typically result from a bank reconciliation are shown here. Notice that the non-sufficient funds, or NSF check, is debited to accounts receivable. This is because the company will attempt to collect the amount from the customer who wrote the bad check. If there is a company error, cash can be either debited or credited. The other account in the entry is the account debited or credited when the error was made. EFT collections usually will be credited to the appropriate revenue account or receivable account, and EFT payments will be debited to the appropriate expense account or payable as the other side of the cash transaction. And so now we want to talk about how to evaluate internal controls over cash receipts and payments. Cash requires some specific internal controls because cash is relatively easy to steal and is easy to convert to other forms of wealth. Remember, we said cash was highly liquid. Moreover, all transactions ultimately affect cash. All cash receipts should be deposited for safeguarding in the bank and quickly. Companies receive cash over the counter and through the mail. Each source of cash has its own security measure. So let's imagine a cash receipt over the counter in a department store. The point of sale terminal provides control over cash receipts while also recording the sale and relieving inventory for the appropriate cost of the goods sold. For each transaction, a sales associate issues a receipt to the customer as proof of the purchase. The cash drawer opens when the sales associate enters a transaction. The machine electronically transmits a record of sale to the store's main computer. At the end of each shift, the sales associate delivers his or her cash drawer to the office, where it's combined with cash from all other terminals and delivered by arm or car to the bank for deposit. Later, a separate employee in the accounting department reconciles the electronic record of the sales per terminal to the record of the cash turned in. These measures, coupled with oversights by a manager, discourage theft. Point-of-sale terminals also provide effective control over inventory. For example, in a restaurant, these devices track sales by menu items and total sales by cash, type of credit card, gift card redeemed, or other. They create the daily sales journal for that store, which in turn interfaces with the general ledger. Managers can use records produced by point-of-sales terminal to check inventory levels and compare them against sales records for accuracy. So we can see there how integrated all of these systems have become. Many companies receive cash by mail. This exhibit shows how companies control cash received by mail. All incoming mail is opened by a mailroom employee. The mailroom then sends all customer checks to the treasurer, who has the cashier deposit the money in the bank. The remittance advices goes to the accounting department for journal entries to cash and customer accounts receivable. As a final step, the controller compares the following records for the day: bank deposit amount from the treasurer, debit to cash from the accounting department. The debit to cash should equal the amount deposited in the bank. All cash receipts are safe in the bank and the company books are up to date. Companies make most payments by check or electronic funds transfer. There should be good separation or segregation of duties between operations and writing checks or authorizing EFTs for cash payments. Payment by check or EFT is an important internal control. The check or EFT payment provides a record of the payment. The check must be signed by an official. The EFT must be approved by an authorized official. Before signing the check or authorizing the EFT, the official should study the evidence supporting the payment. So certain types of satisfactory evidence that a payment is legitimate would be invoices, purchase orders, receiving reports, also known as packing slips, contracts, or approved payment voucher. To illustrate the internal control over cash payments by check, suppose Company A products buys some of the inventory from Company X. The purchasing and payment process follows these steps. Company A faxes or emails an electronic purchase order to Company X. Company X ships the goods and sends an electronic or paper invoice back to Company A. X sends the goods. Next, Company A receives the inventory and the invoice. It prepares a receiving report to list the companies received and compares the invoice to the purchase order and receiving report to make sure the goods invoiced were actually ordered and received. And then finally, in step 4, after approving all documents, Company A sends a check to Company X or authorizes an electronic funds transfer directly from its bank to Company X's bank. For good internal control, the purchasing agent should neither receive the goods nor approve the payment. If these goods aren't separated, a purchasing agent can buy goods and have them shipped to his or her home, or a purchasing agent can spend too much on purchases, approve the payment, and split the excess with the supplier. To avoid these problems, companies split the following duties among different employees: purchasing goods, receiving goods, approving and paying for goods. This figure shows the company's payment packet of documents. Before signing the check or approving the EFT, the Treasury Department should examine the packet to prove that all of the documents agree. Only then does the company know that it received the goods it's ordered and it is paying only for the goods received. After payment, the person in the Treasury Department who has authorized the disbursement stamps the payment package paid or punches a hole through it to prevent it from being submitted a second time. Dishonest people have tried to run a bill through payment for twice, or bill through twice for payment. The stamp or hole shows that the bill has been paid. If checks are used, they should then be mailed directly to the payee without being allowed to return to the department that prepared them. To do so would violate separation of the duties of cash handling and record keeping, as well as unauthorized access to cash. Another thing that we see happening is that the databases now, the accounting information systems, will not allow you to enter in the same invoice number for the same vendor twice. So if I previously had entered in vendor for ABC vendor, invoice number 123, and someone tried to push that invoice through a second time and get it paid again, the system would literally flag invoice number 123 as being a duplicate invoice number for vendor ABC and stop us from paying it. So this is an example where technology has helped to increase some of the internal controls in some of our business processes. It would be wasteful to write separate cash for an executive taxi fare, name tags needed right away, or delivery of a package across town. Therefore, companies keep a petty cash fund on hand to pay such minor amounts. This word petty, of course, means small. That's what petty cash is. A small cash fund kept by a single employee for the purposes of making such on-the-spot minor purchases. The petty cash fund is opened with a particular amount. A check for that amount is often issued to the custodian of the petty cash fund, who is solely responsible for accounting for it. For each petty cash payment, the custodian prepares a petty cash voucher to list the item purchased. The sum of the cash in the petty cash fund plus the total of the paid vouchers in the cash box should equal the opening balance at all times. The petty cash account keeps a set balance at all times. Maintaining the petty cash account in this balance, supported by the fund, is how an interest system works. The control feature is that it clearly identifies the amount for which the custodian is responsible. And now we want to talk about how to construct and use a budget. So a budget is a financial plan that helps coordinate business activities. Managers control operations with an operating budget. They also control cash receipts and cash payments, as well as ending cash balances through the use of a cash budget. A cash budget helps a company or an individual manage cash by planning receipts and payments that will occur in a future period. The company must determine how much cash it will need and then decide whether or not operations will bring in the needed cash. Managers proceed as follows. They start with the entity's cash balance at the beginning of the period. This is the amount left over from the preceding period. Secondly, then, they add the budgeted cash receipts and subtract the budgeted cash payment. So here's what I have to start with. What do I expect customers are going to pay me in the month that I add to it? And what do I expect I'm going to have to pay out to my vendors and my employees in the current month? So the beginning balance plus receipts minus payments equals the expected cash balance at the end of the period. We compare the cash available before new financing to the budgeted cash balance at the end of the period to know whether or not we're going to need to draw on a line of credit or perhaps take advantage of a loan, the proceeds from a loan. Managers know the minimum amount of cash they need, the budgeted balance. If the cash shows excess cash, managers can invest the excess. But if the cash available falls below the budgeted balances, the company will need additional financing. In this case, the company may need to borrow the shortfall amount. The budgeting cash is a valuable tool for helping the company plan for the future. It's also very efficient in the sense that if I have excess cash, I don't want that excess cash sitting around not doing anything for me. And if knowing about that provides me the opportunity to put in a bank and earn interest, well, then that's all the better. This is just an example of a template for a cash budget. Receipts can include collections from customers, investment revenue and proceeds from sales of long-term assets. Payment include inventory purchases, operating expenses, purchases of long-term assets such as property and equipment, and payment of dividends and long-term debt. A subtotal is determined, and then that amount is compared to the budgeted cash amount. If the cash available is less, financing may be needed. If it is more, cash is available for investing. Most companies have numerous bank accounts, but they usually combine all cash amounts into a single total called cash and cash equivalents. Cash equivalents include liquid assets such as time deposits, certificate of deposits, and high-grade government securities. These are interest-bearing accounts that can be withdrawn but with no penalty or interest-bearing securities. Slightly less liquid than cash, cash equivalents are sufficiently similar to be reported along with cash. And lastly, we talk about compensating balances. So the cash account on the balance sheet reports the liquid assets available for day-to-day use. None of the cash balance is restricted in any way. Any restricted amount of cash should not be reported as cash on the balance sheet. For example, cash pledged as collateral is reported separately because that cash is not available for day-to-day use. If the company fails to pay the loan, the lender can take the pledged cash. For this reason, the pledged cash is less liquid. Also, banks often lend money under a compensating balance agreement. The borrower agrees to maintain a minimum balance in the checking account at all times. This minimum balance becomes a long-term asset and is therefore not cash in the normal sense. And so I hope that our discussion this week has given you a good understanding of internal controls, what the internal control structure of a company looks like, why it's important, and particularly why it's important with respect to something as liquid as cash. And then we finished up with a discussion of cash budgeting, which is a good tool for helping a company identify cash shortfalls and needs, and then to line up in advance when we see that coming, how we can efficiently address those in an optimal way for the company. And so please, again, read the chapter closely and make sure that you understand the concepts presented in the chapter and in this discussion, and then move on to the practical side and complete the learning exercises. So thank you very much, and I'm looking forward to meeting again to talk through Chapter 5.